Well, good afternoon, everyone, or at least good afternoon from here in London, as we're doing more and more of these worldwide broadcasts of webinars. Today, I have a dear friend of mine, Louise Pryor. Louise is not just a doctor and qualified in many other respects, but she's also president-elect of the Institute and Faculty of Actuaries. And I suggested to Louise that she might just want to talk today to get some of her pre-thinking for her office in line, and she jumped at the chance to share with the FS Club her thoughts on the challenge to insurance and pensions from sustainability risks. So I'm looking forward to a wonderful conversation. Now, you'll know me. I'm Michael Mainelli. I'm one of the directors of Zien. And as I frequently say, I am delighted to introduce these webinars. And the reason that I'm delighted is that our sponsors, whom you can see here, allow us to range widely and freely across technology, economics, and finance. And today we're going to certainly be touching on economics and finance in the sense of actuaries and across the planet in terms of sustainability risks. The agenda for today is one that frequent viewers will know. My job is to get out of the way and let you hear from our expert, Louise. Louise will be speaking for approximately 20 minutes, and then we have approximately 20 minutes left for Q&A. A few points, if I may. Firstly, the slides will be posted. In fact, are already posted. I can see if you look in the chat room. Secondly, the recording will go up within about 48 hours. So if you wish to view it again or share it with friends, family, and colleagues, that's certainly possible. And you will get a notice about that. And finally, but most importantly for this afternoon, we're going to have a conversation with Louise. So please type your questions in to the GoToWebinar question facility, and I will feed them in to a conversation with her. A note that Louise will get all of your questions and comments and observations along with your email. So if you want to send her something, just type it in and she will get it, even if it's not something that we wish to bring up today on the webinar. So enough of the housekeeping, I think. And if I could hand over, Louise, the floor is yours.
Thank you, Michael, and it's great to be here, and welcome to everybody. So I'm here to talk about the challenge to insurance and pensions from sustainability risks. And right off, what I'm going to say, thank you, Michael, is that we're talking about risks, but we start with certainties. Moving on. Climate change and biodiversity loss are certain. They're not risks. They are happening. I'm not going to talk to you about the details of climate change. I'm sure most of you have heard a lot about it in the last few years. Biodiversity loss is a bit newer to some of us, so we're going to start off with a poll just to check how much you know about it. And the question is, how much higher than the baseline rate are current extinction rates? Are they 1 to 10 times higher, 10 to 100 times higher, or 100 to 1,000 times higher? Please select just one and we'll see how much you know about this.
That's super, Louise. As you can see, folks, I've launched the poll, so just use the poll answering facility. Over 2/3 of the audience, this is the actuary in me, I guess, 75% have voted in less than 20 seconds. I'll leave the poll up in just a little bit. We're well into the 80s, just for those who are using this for the first time. That's great. And if you don't mind, I'll now close the poll and share the results.
So, pretty much evenly split between 10 to 100 times and 100 to 1,000 times higher. Very, very interesting. If we move on to the next slide, you'll be able to assess your knowledge. According to the Dasgupta review, which was published earlier this year, a big review commissioned by the Treasury on biodiversity, current extinction rates are 100 to 1,000 times higher than baseline rates. I was astounded, absolutely astounded when I read this. I mean, I thought they were high. I mean, I guessed it was high because, you know, we're all worried about these things. But 100 to 1,000 times higher was mind-blowing. Really, really stunned me. And there's a lot of other really good stuff in the Dasgupta review. If you haven't read it, I highly recommend doing so. I put the link on the slide there. There is a short sort of 6 to 8 page summary which covers the highlights, or you might say lowlights, and well worth reading. So if we're talking about certainties, where does the risks come in? Moving on, we can see that the risks come from the potential consequences. We know that these things are happening. We know that the climate is changing, that we're losing biodiversity, but what are the consequences? And it's here that the risks arise. There are potentially extremely severe impacts. I'm not saying that all these bad things will definitely happen. I'm saying that they have the potential, and that's what we mean by risk. We're not talking about certainties. We're talking about things that either might happen or might not happen, or we don't know the extent to which they'll happen. So moving on, what challenges do these risks pose us? And I'm going to talk about challenges in 3 areas, really. Risk management, what challenges do they pose to risk management? And then challenges to the financial services industry. I'm going to be talking specifically about investment, insurance and pensions, about how the industry can incentivize and support action to manage the risks, and also about how these industries can serve their end users, the consumers. And briefly along the way, I'll touch on the regulators. So moving on, we're going to look at risk management in particular. And I'm going to explain to you why sustainability risks are different and how we can approach them. So we can see why sustainability risks are different on this slide. I'm not going to go through it in detail. There's a lot of stuff here. But basically, a lot of the risks that we're used to, if you like, the risks that we insure a lot, things like motor accidents, things like life insurance, mortality, business continuity, all these things, they're risks that happen over and over again. We get a lot of data. We can calculate probability distributions for frequency and impact, very limited in the extent of their impacts, and you can often make things right again after they've happened just by throwing money at the problems. With sustainability risks, that simply isn't the case. These are not things that are going to happen over and over again. It's a long, drawn-out, chronic process. And there's significant uncertainty, especially about the impacts. We don't know exactly how severe they're going to be. They're incredibly wide-ranging, systemic, causing fundamental changes. And the real biggie, to my mind, is that there's no going back. However much money you throw at the problem, you can't restore a species that has been made extinct. You can't unwarm the world. You can't refreeze the ice caps if they melt. So this all creates huge problems. And to me, the really important bit here that a lot of the other things derive from is the significant uncertainty. So let's just talk about, on the next slide, thank you, Michael, on what I mean by uncertainty. It's a term that is bandied around a lot. You hear about Knightian uncertainty, you hear about radical uncertainty, you hear about deep uncertainty, and people often draw a distinction between uncertainty and risk. And I think that's important. I'm not particularly hung up on the differences between all the different types of uncertainty. People develop new terms, slightly different definitions. But the main point is risk you can get a handle on. You can analyze quantitatively. You've got data. You can calculate probability distributions. Uncertainty you can't for various reasons. And the thing about uncertainty is that you don't have data, you don't have probability distributions. It's typically unquantifiable on many different timescales and on many other sort of granularity measures. And things like sustainability, the risks or uncertainties, one might say, associated with sustainabilities are non-stationary. So it's changing under your feet all the time. To my mind, this all arises because there are intrinsic limits to predictability in complex systems. We're talking about a really, really complex system here. The way the Earth operates as an environment, as a biosphere, all that sort of thing, the climate, all the rest of it, and then how it interacts with our economic and financial world, which itself is an incredibly complex system. The interaction between the two just makes it even more so. You've got a system that is subject to dynamic change. However, that doesn't mean that we should just say, oh, uncertainty, we can't quantify it, there's nothing we can do. We absolutely do have to do something. This is what risk management is about. And there's two basic approaches, both of which are needed. The first is mitigation, which you can think of as avoiding the unmanageable. How do we stop damaging the environment so much that we won't be able to handle what happens? We have to think about our impacts on the environment. We think about reducing emissions, reducing biodiversity loss, and that's pretty much what gets all the attention. Mitigation is the sexy bit. Mitigation is about moving to net zero. Mitigation is about achieving the Paris goals, though there are some adaptation goals in Paris, but the headline ones are certainly mitigation. Adaptation, on the other hand, is talking about managing the unavoidable. Some change has already happened. We're already at about 1 degree over pre-industrial levels. In Paris, we're trying to keep it down to 1.5, maybe 2 degrees, so there's some more change going to happen. We're seeing change already. The wildfires in California and Australia, increased flooding over here, storm surges, all sorts of problems we're seeing. So as well as avoiding the unmanageable, we have to manage the unavoidable. We have to think about environment's impacts on us and how we can handle it. And that's adaptation. Both are really important, and I think that's a really big thing to think about, and is how they fit together, because they do. In many ways, they're complementary, but also some of the same measures can be used for both. So just thinking about how bad the problem is, are we talking about the unmanageable or are we talking about the unavoidable? Let's go to our next poll. If you were 50 years old today, and this may be a stretch of imagination for some of us, I freely admit that, but just imagine you were born in 1971, what proportion of global fossil fuels emissions that have occurred since 1751 have occurred over your lifetime? So just imagine you're 50 and think about what proportion have happened while you've been alive. Since you were at your mother's knee.
A 76-year-old friend of mine had his birthday today, and he celebrates it as 18 years old and 58 years of experience.
Sounds great to me. And of course, we are talking base 10 here, folks. Just reminding you.
Great. Well, 80% of the audience have voted, 85%. I'm just going to close the poll in a second. That's great. And we have a somewhat guilty audience out here, I think. I'll share the results now. And 61% believe it's 85%.
That's very interesting. I'd be interested to know how many people have had a sneak preview at the slides. Let's move on to the next slide. So we've got 85% there. If we move on to the next slide, we can see that means, on average, our audience is about 65 to 70 years old, I guess. Okay.
I knew we'd have an actuary on today.
The point is, I think the point to get across here is that so much of this has happened so incredibly recently. So the pace of change is just enormous. And it really does mean that we have to do something about it pretty soon, else things are going to get even more out of control than they are. So moving on, let's think about how we can manage sustainability risks. No data, no probability distributions. We have to use qualitative methods of assessment. So this typically means thinking in terms of scenarios, or as one might call them, narratives, telling stories about what could happen. And this is really important. And scenarios should never be about what you think will happen. They should be exploring possibilities, plausible but unlikely. And there are some difficulties with coming up with good scenarios. One is unexpected linkages. I think we've all seen that in the COVID, how the COVID scenario has played out in practice. Who ever thought that jigsaw manufacturers would have an absolute boom? Apparently this is the case. An unexpected linkage that I would be surprised if many scenarios had included. And the other question is, are they extreme enough? People who develop scenarios are often accused of not making them extreme enough. I think that's possibly true to a certain extent, but a great deal of it is because our customers, if you like, the decision makers, the boards, the main boards or whoever who look at these scenarios over and over again, they say, this could not possibly happen. This is way too extreme. I don't believe it's remotely plausible. And that is one of the problems, that it's not only the people who develop the scenarios who's got to be prepared to come up with extreme scenarios, it's the people who make the decisions who use the scenarios to support them. And everybody has to be aware of how extreme the scenarios can be. And there's a huge desire, I think, on all our parts, just to kind of deny what's happening or what could happen. There's a great book out at the moment, All We Can Save, a collection of essays about sustainability. A really nice piece in that is about a woman who went round looking at condos in Florida and asked about flood risk at all the condos she was looking at. And the realtors, almost without exception, said, no, there's no flood risk here. There are too many millionaires here. Flood is never going to happen. That is not a realistic outlook. You have to be prepared to look at the extremes. So moving on, we can talk about some specific risk management challenges. We could see fundamental changes in the way the economy operates, in the way the financial world operates, and the linkages between all these things. Do the models remain valid? Are things like modern portfolio theory going to remain valid through a radical shift in our economy? Are our current mortality models, as an actuary, this is something that, is very much at the heart of what many actuaries do. We have models of how mortality is going to change over time. Are they going to stay valid as some of the impacts of physical impacts of climate change, biodiversity loss kick in? We don't know. It's something to think about. It's a challenge. Have we got appropriate scenarios? It's quite easy to come up with, if you like, fairly small scale scenarios. Think about what the effects might be on markets and so on, what the effects might be on GDP, on this, that and the other, what the effects might be on mortality, what the effects might be on flooding, property insurance and so on. But are the scenarios consistent across both assets and liabilities? Are they true system level scenarios rather than just bits and pieces cobbled together? And finally, I think it's important to realise that we're talking about global systemic risks here, and you simply can't hedge those. What do you hedge them with? Nothing. I mean, just can't be done. So moving on, we've talked now about some of the challenges to risk management. Let's think about how our industry, investment, insurance and pensions, can incentivize and support societal risk management, how we can support adaptation and mitigation. We're hearing a lot about green finance, which is great. And, I'm very, very pleased to see this emphasis on it. But you've always got to think about additionality here. Are you actually making a difference? Are you changing what happens? Just investing in the equity market, the listed equity market, in companies that are doing good stuff isn't necessarily going to make more good stuff happen. It's probably a good thing to do. And certainly I think that divesting is probably a good thing to do. For a start, just ethically, are you prepared to make money out of destroying the world? I mean, that's a question you have to consider. But, is it going to do any good? So you really do have to think in terms of the impact. There's a lot of work being done on impact investing at the moment. The Impact Investing Institute released a few months ago an excellent report on impact investing in pensions. Well worth a read if you get hold of that. And on the insurance side, we have to think about how the insurance business itself, not just the investment side, actually supports mitigation and adaptation. Do the policy structures that we currently have work for this? I would claim that in many cases they don't. We're talking about policies that typically look at the short-term risks. They're priced over 12 months. We're talking about long-term risk management here. And I think there's a lot of misalignment that the policies we have don't take the long-term into account and don't support long-term action. And I think this is a huge challenge for the insurance industry to reinvent itself to better serve society in this respect. Which brings us on quite nicely, moving on, to how our industries can serve our end users, if you like, the consumers, the policyholders, the pension fund members. New covers and policy structures, talked about that a bit, but also, are we, in the insurance industry, are we covering the risks that people want covered? We talk about not being able to insure against systemic risks. You certainly can't insure against climate change happening. That's absolutely right. But are there ways that we could insure against some of the volatility, for example? Could we, sort of index flood insurance against expected rates of flooding, even taking climate change into account, and insure the excess or whatever over the indexation, if you like? Can we think about these risks in new ways to think about what the end users actually need and want to be protected against, and come up with new mechanisms to do that? In the investment industry, one of the big challenges, I think, is I've put 3 bullet points here: passive investing, default options, and lifestyling. But it's all pretty much the same sort of thing. Many of us, and I include myself here, are not actually interested in doing investment. I will typically, if I don't choose the default on my pension schemes or life insurance, I will just choose an index fund or whatever. Are there passive investing funds that serve users, consumers, who would like to invest sustainably, would like to invest for impact, and essentially want to do so passively rather than actively? And we really need to think about how we can serve those end users. Which brings us, moving on, to the final, next to final thing. What's the whole point of investment, of pensions, of insurance? Is it to make short-term financial gains, or is it to serve the long-term prosperity of the investors, of the pension fund members, of the insurance policy holders? It has often been said that a 4-degree world is not insurable. Should insurance companies be following short-term profits, by ensuring activities that will ensure that their long-term future is not possible because insurance will not be viable in the world that is being produced. We've got to think of all these long-term issues about universal ownership, how all these big investors actually own a whole slice or potentially a small slice of the whole economy. So therefore they be thinking about how to serve the economy as a whole in order to increase the overall returns and the interests of their stakeholders. And finally, there are some challenges for regulators here. Is regulation for short-term solvency and consumer protection consistent with supporting mitigation and adaptation, which are short to medium to long-term goals? And even in the short term, it's increasingly obvious that the markets today are not reflecting these risks that we know about. There could well be a Minsky moment when things are realigned. And what does that mean even for these short-term solvency goals that the regulators have? In summary, there are huge challenges here, but there are also huge opportunities, a fantastic opportunity to reinvent whole aspects of the financial services world. As a friend of mine says, this is the biggest business and career opportunity in several lifetimes. And really, it's up to us to grasp that opportunities so that our industries can both serve society and we can feel that we are doing something worthwhile and something really, really interesting too. So that's it from me. I hope that there have been some questions coming in, Michael.
There certainly have been, Louise. And folks, please do get your questions in early so that we have time to address them. Trevor Hilder points out that large parts of the Netherlands have been below sea level for centuries. And he then moves on to your point about Florida and real estate. Surely the millionaires will pay for the mitigation of flood risk. But his deeper question to you is really, are you saying that we're not spending enough time investigating adaptation?
Yes, I think so. I think there are a number of people who say that we actually shouldn't think about adaptation because it's accepting defeat. And if you push adaptation and say we should be thinking about adaptation, the argument then is that people will think that we can adapt to everything so that we needn't bother about mitigation, which is, I mean, I can kind of see that argument. And I think it does have some appeal, but the point is we can't not adapt because change is happening. So we've got to think about adaptation, and there's lots of things we can do that actually do both. So things like a lot of nature-based solutions, for example, to climate risk, a lot of things like rewilding. We hear a lot about rewilding. We hear about how peat could be a huge carbon sink if our peatlands were managed properly and so on. And those both help with adaptation because they help deal with flood risk, but they also help with mitigation because they absorb carbon. So there's lots of things like this that actually serve both purposes. And we need to think more about the adaptation side alongside the mitigation side. I'm certainly not saying we don't need mitigation. We absolutely do, but we need both.
Taking that kind of approach really of risks and then responses to them, Ian Harris is kind of curious, what would your thoughts be on geoengineering, where you're to some degree taking on a lot of risk to address a risk, and I guess that falls into the adaptation category much more than it does the mitigation.
Well, it depends what you're geoengineering in order to achieve, doesn't it?
Well, let's say like a whole bunch of aerosols up there to try and reflect sunlight, but you've got to keep them up there. You've got to keep it going. And of course, if that fails, 20 years out, it's actually worse than if you hadn't done anything, perhaps.
Yeah, and you've got the potential unintended side effects. I mean, do we really understand enough about how aerosols in particular operate in the upper atmosphere and so on? I'm wary because we're talking about a fairly major shock to an extremely complex system, and goodness knows what will happen. I'm also wary because it's kind of an excuse. It's kind of saying, look, there's a magic bullet. There's a way we can just throw money at the problem. We needn't actually change our behaviour, and that is, to my mind, dangerous, because I simply don't believe that throwing money at the problem, throwing technology at the problem, is going to be enough. And we shouldn't just place our reliance on silver bullets. Wouldn't say there's no room for them, but I'd definitely say don't rely on.
Yeah. Well, I think a lot of people have come to the conclusion we should keep researching them, but deployment might be some ways out. Hugh Purser asks, will adaptation deliver on urgency? Can investors mitigate global risk simply by stopping investment in the problem industries?
No. There's momentum there, isn't there? I mean, if you stop investing at all in problem industries, those industries will wind down over a period. They mightn't wind down as quickly as we would like them to. There aren't any simple answers here. And we're feeling our way. The trouble is we've got to feel our way quite rapidly. Because of all the graphs coming out of all the, IPCC reports and everything, they are pretty scary if you look at them. And people say, but it's long term. We've got to do it for our children's sake or for our grandchildren's sake. I'm saying, and I'm under 85 or whatever, so I'm maybe less than the average age of this audience, but I'm actually quite old enough for many things, thank you. It's a problem for my own lifetime. I'm not doing it just purely out of selflessness. I'm doing it for myself too.
Got an interesting point here from Nikki Holzhausen. Could we please have your thoughts, Louise, on public-private partnerships in the context of sustainability?
I don't know. I have many thoughts. What I feel is that anything we can do to get more investment into this is good. I mean, there have been problems with public-private partnerships. Whoever invented that term has got something to answer for. There have been problems with them in some areas. They've been somewhat successful in other areas. I'm not a purist, and I mean, I can absolutely see the arguments for governments and industry working together on this.
You mentioned universal ownership, and Julia George is curious, sort of follows to some degree from the PPP point. How do you see universal ownership working in practice to deliver overall good?
I think universal ownership is a very powerful concept, or it works for me as a way of thinking about it. That yes, I, as a member of several different pension schemes, and in that way an investor in several large index funds, I own a slice of the whole economy, and therefore I benefit when the whole economy does well. And the fact that, in a sense, we shouldn't think of investment purely in competitive terms as this investment manager does well, which means that investment manager does badly, and it's a zero-sum game. What we would like is for everybody to do well, and universal ownership, I think, provides a really nice framework for thinking about that. We then get the problem is that everybody thinks that they are too small a fish in the big pond, and so nothing they can do will make a difference. I mean, it's the tragedy, the somewhat misnamed tragedy of the commons all over again. And it's we have to change the story. We have to change the narrative. We have to not think of it as I'm going to do better than you. It's the question of how can we all do better than if we did nothing.
Okay. I've got a couple of questions related to information and data. Gerardo Lopez Saldana is asking, satellite data is often used to assess climate risk. From your point of view, will the insurance and pension industry be able to use more of these products, even if the spatial detail and uncertainty might not be quite adequate?
I'm not fully sort of aware of exactly what data the insurance industry is using at the moment. I suspect that they are using a lot of satellite data. They're not stupid, and this data is incredibly useful, especially in the catastrophe modelling field. I can't imagine that they're not using that sort of data. Pensions and things, it's a bit more interesting because it's really a general, could you use satellite data to analyze your investments more, to think about the vulnerabilities of your investments to various sustainability risks? So it's really one for the investment analysts. And there is a bit of work going on in that respect. I know of people who are, for example, comparing companies, organizations, TCFD disclosures, so these are the climate-related financial disclosures, and saying, look, you haven't sort of talked about some big risks, but I can see you've got these huge facilities in very low-lying coastal areas. Do you not feel that there's some climate risk involved here? Which is an interesting thing to do. So for that sort of analysis, I think, yes, satellite data can be very useful.
You touched nicely on TCFD. We've had quite a few debates in FS Club over the last year or so, with some impatience, frankly, about the ESG approach, which is to raise the cost of capital against reporting standards. Wondering if we're ever going to get there. It's been going on for ages. And I think it's boiled down into a couple of things I might point out. One, Sahaj Desai is curious just about how do you standardize this reporting and the impacts of business. And Britain is talking about a new standard and a new taxonomy, which is, I think the economists referred to it a year ago as an alphabet soup out there. But Sahaj makes an interesting point here for me. Should CFOs and FP&A teams be trained and tasked with doing all this stuff, or does this really require a new team to be put in place?
That's a really interesting idea, isn't it? Is it just, well, I say just, is it financial, primarily financial? The way the modern world has gone is to express everything in terms of money. That this is how we value things. We place value on something is by assigning a monetary value to it. That isn't necessarily the right thing to do. We're talking about the whole concept of natural capital here, obviously, and human capital and all these other things. And should we be thinking in terms of organizations, how they run themselves? Should they be thinking of everything through their balance sheets, through their monetary balance sheets, or should they be thinking about other types of worth as well? And if so, should there then be a separate team who's tasked with thinking about that type of worth? I wouldn't like to completely separate it because it could become devalued. People could just think, oh, it's that nice, warm, fuzzy thing. But actually saying that we should have people who are experts and think deeply about something other than just money is a good idea.
Bob McDowell makes 2 points, really. His first one's very much about, you haven't spoken much about the cost of carbon. And again, this impatience with the cost of capital. If it were really costing companies 40, 50, 100 euros a ton, they'd do something about it. This sort of soft ESG approach is lengthy and subtle at best. But his other point is really, isn't the biggest area you'd like to deal with in terms of risk actually been government policy risk? Because the government policies have been clearly defined, both in Kyoto in 97, clearly defined in Paris, but governments don't seem to follow them, and so it makes it difficult for business to operate. So what are your thoughts on the policy risk of governments?
We need to make it so that it's impossible for governments not to follow up, not to actually implement the policy they've committed to. We need to do that, obviously, through the ballot box, through lobbying, through however we can. We are seeing that happen through the legal system. We're seeing that happen certainly in the Netherlands. There was a court case where the government were held to account for not implementing their own policy. And I suspect that we'll see more of that happening. It is a big problem because we're talking about big systemic, globally systemic risks here. It can't be done at the individual level. It can't be done just through you and me driving a bit less, eating a bit less meat. There's got to be much, much broader action.
Rolf Kertze asks, he says, hi Louise, this is a global issue impacting us all. How do you see developed and developing countries working together, including and beyond the financial support that forms a part of the Paris Accord?
Yeah, we've absolutely got to think about that. I mean, let's face it, it's the developed countries who have essentially benefited from and got us into this mess. And it's the less developed countries who are going to suffer most. And it is clearly not right if we then put all the burden of getting us out of the mess onto the less developed countries. I mean, it's not right, it's not fair, and probably not effective either. We do have to work together. I think there are opportunities for leapfrogging, for doing what's happened with the phone system in some countries where they've sort of skipped the landline stage altogether. Can developing countries sort of skip the fossil fuel stage and move straight to renewables, for example? And, this is the whole concept of the just transition, which is really, really important. And unless we get that right, we're not going to succeed, basically.
We've got time for one final question. It's subtle, it's interesting. I'm delighted to have it posed. It's from Martin White. Martin's asking, Louise, do we have an idea what our physical world would look like if we were already net nil carbon? And also, what would our investment world look like if we were already there? What would the changes be?
Oh my goodness, isn't that a good question? Do I have to answer it? Yeah. I think our world would be a great deal more pleasant. We'd have much lower pollution levels for a start, because we wouldn't have all those particulates going out into the atmosphere. There'd be we'd be a lot healthier, sort of from that point of view. We might be less healthy if climate change has already happened and disease vectors have changed and all that sort of thing. So difficult to say. It'll be quieter. Internal combustion engines, diesel engines are very noisy, so it'll be quieter. How will the investment world change? Well, the constituents, the main listed companies, very different makeup of the big indexes, obviously. Will people I hope that it will mean that people use different criteria. Can we do it? Okay, so can we make all these changes without shifting to having a more long-term view rather than a sort of short-term betting mentality view? I'm not sure we can. So maybe if we manage to transition effectively, maybe that view will have changed so that investing really will be for the long term and people will be thinking about the long-term issues more.
Yeah, personally, I kind of ponder sustainability. To me is linked with lower volatility, and I wonder if we'd have a less volatile world in the investment space as well. But intriguing. Louise, sadly, one of our finite resources is time. And so I'm going to sadly have to kind of bring this to a close. But it's been so kind of you to share with us your thoughts, particularly on the year ahead that you face. And we're seriously delighted that you've taken this issue, very much to your heart and are running with it. I have 3 rounds of quick thanks to give. Firstly, as ever, to our tolerant and expansive sponsors. I hope that it's been interesting to see, particularly an actuarial view. I don't mean to box Louise in, she has many qualities, but an actuarial view on potentially the greatest risk of our time, and delighted for that. I'd also like to thank the audience. As ever, you've been very helpful and participative and drawn some of the issues out here today. I wish we had a little bit more time because there are a few that I've had to sadly let slip. A reminder to you, next week is extremely full. We kick off with Mishkan Dorea looking at a recent report on the regulations around blockchain. We then have 3 days on employee share ownership as part of the British Isles Symposium on share schemes. And then we conclude on Friday with artificial intelligence and commodity trading. So it's a full week next week. As ever, go to the website to check things out. But Louise, it remains for me to thank you personally. It was so kind of you to rise to the challenge and to share your thoughts in advance. We don't need to join the Institute because we've already heard what's coming up next year.
Well, thanks very much for having me. I've really enjoyed it.
Thank you. I can't open the floodgates of applause, but I can produce my Korean karmic clapper, and hopefully that's recyclable applause as well. And we look forward to having you back. Perhaps a roundup of what your year was like when you did it. So thank you so much for coming.
Thank you. Bye.